Can we just start off with the calculation of these duties? Now, Jack Mintz told us there's some nuance there, but it appears that they've just calculated them not based on the actual trade barriers imposed by trading partners.
Well, somebody out there cracked the code because when you're taking a look at what the White House did to get these numbers, was they took the trade surplus that each country has with the United States and then divided it by their exports to the United States. And that's how they came up with these reciprocal tariff rates, which isn't even an estimate of what their tariff rate is, but is a justification for lopping on these massive tariff increases across wide swaths of Asia and, of course, in Europe. So it doesn't really make a whole lot of sense. It's just a justification. You've got a situation where countries, for example, like Germany and France, okay, what's their net effective average tariff rate? You know what it is? 2%.
Wow.
What did Trump just do and his team? They slapped on a 20% tariff rate on the EU. Japan has an average tariff rate, 2%. They just got slapped with 24%. So none of this makes a whole lot of sense. But I suppose that maybe, since last November, we've become immune or numb to all this insanity. But you can't justify these tariff rates that were just imposed based on what the actual number is from these other countries.
I mean, people are joking about, a tariff on an island inhabited by penguins, but I mean, it's serious stuff, isn't it? Millions of jobs could be at risk here around the world.
Well, that was interesting was that we had this short covering rally in the stock market in the past week. And people were saying, oh, well, this is, we're going to get to April 2nd and the uncertainty is going to be lifted. To which I said, no. We're going to get a new wave of uncertainty because what's happened in the past 24 hours or since 4 o'clock yesterday is that the trade war has changed fronts. It's moved away from Mexico, Canada, and now we're fighting a new trade war on a new front with Europe and with Asia. And although we sit here as Canadians and we look at, well, what's the impact here and, on autos and steel and lumber, and of course we're breathing a sigh of relief that we didn't get hit with those reciprocal tariffs, although who knows what's going to happen because everything is so haphazard and the Trump team changes things by the day. But I think we have to understand, and I think Canadians as a whole are globalists. We're a small open economy. We rely on global trade flows.
Although we're very dependent on the U.S., of course. David.
Well, we're very dependent on the United States, 100% true. However, take the Canadian dollar, for example. It moves on the contours of the global economy. It's a torque on global GDP growth, okay? So the point is that, and this will come back for the Canadian economy, because although we're largely dependent on the U.S., we're not 100% dependent on the United States. And there's going to be a big negative flow through, like a secondary impact in terms of what this means for the European and Asian economy. I don't know if there's a complete understanding of how important Asia and Europe are to the global supply chain, to the North American supply chain. So this is a massive upheaval. And the one thing that has not changed is uncertainty. That's one thing that has not changed. We can breathe a sigh of relief that we didn't get hit with reciprocal tariffs yesterday. However, the bug of uncertainty hasn't been lifted. That's what people were saying. Oh, the uncertainty. No, we just basically are in a complete book of uncertainty, and we just finished one chapter, going to a new chapter. And let me just say that, notwithstanding what the Trump team does or doesn't do, it's so inconsistent and so haphazard, and it's trade policy on the fly, that the uncertainty alone is going to cause households and businesses that make up the private sector economy to pull back on their spending. Just that bug of uncertainty. The economists that actually first started modeling uncertainty was John Maynard Keynes.
Mm-hmm.
And
it's damaging
because the economy is dictated by behavior and expectations. And of course, it was Milton Friedman that won a Nobel Prize in economics for modeling expectations. So all this stuff that seems so, unobservable, uncertainty, but you can model uncertainty, actually. There are statistics. And the uncertainty, which is between, we're talking about 2 to 5 standard deviation events from the historical record, is enough to drain, just the uncertainty alone, enough to drain GDP growth, not just here, but in the United States, by between 1 and 2 percentage points off the baseline level, which is roughly just over 2%. And that's how you get to zero growth. And I got news for you. At zero growth, you might say, well, it's not negative. Oh, that's not a technical recession. Except with 0% growth, you get rising unemployment. And then you get wages contracting. And then you get consumer spending contracting in volume terms. The next thing you know, we are in a recession.
And inflation is not going to be brought down by this thing, apparently, either.
Well, the near-term impact is going to clearly be inflationary. And this is, once again, it's like, I'm just rolling my eyes when I hear what's coming out of the administration. And then all the sycophants that actually believe the baffle gap coming out that the foreign producer is going to pay the cost. And then they're thinking, these people don't even understand what a tariff is. The exporter does not pay the tariff. Who pays a tariff? The domestic importer pays a tariff. And then the question becomes, what are the elasticities, okay, industry by industry, in the consumer space or in the supplier space, and how much of that gets passed on? So of course it's inflationary. I don't think it's going to be sustainable, and I'll tell you why. And we saw, for example, we saw the Challenger numbers today. Hirings are tumbling. Layoff announcements are skyrocketing. And it's over and beyond just what DOGE is doing. So you're seeing a broadening out in the layoff numbers. It's not shown up in the jobless claims numbers yet, but there will be a lag. So what's going to happen is the labor market is starting to show cracks. The once hot labor market in the United States is starting to show cracks. And what's going to happen with that as it loosens up is that bargaining power for the worker is going to go down. So what's going to happen is that this price shock is not going to feed into wages. Unfortunately, if this is a different part of the cycle where the unemployment rate was going down and not going up, then you would get a wage price spiral. By the way, that is why the inflation wasn't so transitory in 2021, 2022, because we had a very tight labor market, okay? And so the prices from the supply shocks fed into wages fed into prices. And 18 months wasn't 18 years. It wasn't the 1970s, but 18 months was a lot longer, certainly, than I thought it was going to be. But that's what happened. So I'm not so nervous about inflation being persistent, okay? I won't say transitory this time, okay? I'll say it won't be persistent, because I'll tell you why. There is no permanent inflation without it seeping into wages, and it's not going to happen this time around. So what does happen, Andy, and this is the problem for the economy, okay, is that it's going to lead to a contraction in real personal income in the United States. What does that lead to? Negative real consumer spending, which is 70% of the U.S. economy, and 20% of the global economy is the beloved U.S. consumer. That's why their trade deficits are high, because the consumer there spends like it's nobody's business. So I'll tell you what, the U.S. will not be complaining about trade deficits anymore, and I'll tell you why. Because as they go into a recession, the consumer's going to hunker down, and those import numbers are going to implode. So the trade deficit that President Trump wants to eliminate, will be eliminated, but not for the reasons that he thinks.
It feels like we've gone back centuries here in the sense that it used to be companies who would be run on a mercantilist basis. You try to get gold, beggar my neighbor. But then Adam Smith and modern economics came along and talked about comparative advantage, and everybody wins by trade. But they seem to be rejecting that modern take.
Well, I think it was in 1890 that William McKinley embarked on the McKinley tariffs. And you're right. You're not going to hear Donald Trump talking about the works of Adam Smith or David Ricardo, but he does talk a lot about McKinley and the wonderful era of the McKinley tariffs. Never mind that, in the next decade after those McKinley tariffs, the U.S. spent more than a third of the time in recession. Oh, that we won't talk about. But the wonderful McKinley tariffs, by the way, the McKinley tariffs, 1890, then by 1894, under a new government, they were totally rescinded. And that's the one thing I think that we got to just sit back, take a deep breath. This is not going to be permanent. This is why, one of your earlier comments was this attempt by the Trump team to draw in manufacturing production from abroad into the home country, the United States. I don't think that's going to happen. because I think that there's a sense, and I think a rational sense, that this is not going to be permanent. Okay, you're already seeing, for example, cracks emerging. I talked about cracks in the labor market. There's cracks emerging in Trump's support, not just public approval on the economy, but in Congress. And you're seeing, for example, in the Senate, they just passed a resolution to try and get these tariffs, especially on Canada, rescinded.
Yeah. And
we have midterms. It's the beautiful thing about the checks and balances, and we have elections in the U.S. every 2 years. And so I think that the odds that this is going to be a permanent situation, it could last a couple of years, that's for sure. But a business making a relocation decision is thinking about the next 5, 10, 20 years. A CEO is not thinking about the next 1 or 2 years to make that decision. So this hope that we're going to be seeing millions and millions of factory jobs and hundreds of thousands of production facilities relocating to the United States, I believe, is a pipe dream.
So the Republicans joined with Senate Democrats in the U.S. in a 51-48 vote to advance a resolution to pull back Trump's emergency power to impose levies on Canadian goods. So some of and Bloomberg's take is the Republicans are splintering over these tariffs.
Right. Well, because and the Republicans in those states that do a lot of trade with Canada. And so it's completely logical. But, then you start thinking about, what's the next phase of uncertainty? See, right now, we're just talking about trade. We're going to have to deal with the fiscal side. The one thing that,
What do you mean?
Well, the debt ceiling.
Oh, okay.
The debt ceiling, this is going to be, okay, let's talk about what's going to be next on the front pages, not what's on the front pages today or the past week, couple of months. The debt ceiling, the U.S. government is quickly running out of money. By the end of May, they're going to be hitting the debt ceiling. We could be back into, like we had back in the summer of 2011, do you remember that? Where the U.S. faced a debt default.
Right.
Not a debt default, a debt downgrade by S&P. But there's a risk. There's a risk here that the debt ceiling is not going to get raised because you got no Democrat support, and you got a very fractious and divided Republicans right now. And then on top of that, you're talking to me right now about how now an increasing number of Republican senators are now voting with Democrats to rescind this ridiculous emergency measure to levy these tariffs against Canada. The next big news over and beyond the debt ceiling issue in May is going to be Trump's big, beautiful tax cuts. And how are they going to get funded?
Renewal of tax cuts, I think.
Well, it's not just renewal,
Okay.
There is that's the first thing is to avoid the fiscal cliff by not having the 2017 tax cuts or many provisions of them expire at the end of the year. But he's also campaigned on cutting the top marginal corporate rate from 21 to 15%. SALT deductions, no tax on tips. He's got a whole bunch of other things that he campaigned on. So fiscal policy, so we're talking trade, 100%, that's not going to go away. We're going to layer all this trade and tariff uncertainty, which is not going away, and we don't even know how Europe and Asia are going to be responding. There will be retaliation, we don't know what form. So this bog of uncertainty on trade, we're going to layer that complexity in the second half of the year with fiscal uncertainty in the second half of the year. And all I can say is that I believe that we could see a repeat of the summer of 2011. It didn't precipitate an economic recession, but let me tell you something. If you were long risk assets in the last time that we had this fiasco on the debt ceiling, it was not a pretty picture for the financial markets.
And people are fleeing to bonds today. It seems the yield on benchmark treasuries has gone below 4% for the first time since Trump took office.
Yeah. Well, so what's the bond market telling you here? It comes down to your comment before about inflation. We're going to have temporary inflation, but people that are buying bonds, they're a long duration animal. The bond market is telling you that the inflation is not going to last because the economy is going to weaken more than a lot of economists expect. And what happens with the weakening economy is there's no ability to pass on those price shocks from the tariffs. That's what the bond market is telling you. The bond market is telling you the economy is going to weaken more and dominate the initial inflation shock we're going to see from the tariff increases.
David, we're tight for time, but should people go to cash now? I know that's a kind of a facile question, but should people think about just getting out of stocks for now?
Well, I think that if you're tactical, like let me put it this way, it all depends on your view. Okay, if you believe we're going to emerge from all this without a recession, I'd say you got a buying opportunity in your hands like right now. But if you believe that this is a big enough policy shock, and by the way, I think it is, that will tip the economy into the recession. You see, here's the risk. Nobody believes there's going to be a recession because once burned, twice shy. We didn't get the recession in 2022 and 2023 when we should have after the most radical tightening in Fed policy since the Volcker years. But of course, we had radical fiscal stimulus under Biden and a massive wealth effect to everyone's 401k plans from ChatGPT and NVIDIA, which terminated the bear market in late 2022. All that's in the rearview mirror. If you believe we're going to have a recession, and I think that's the base case scenario right now, this stock market sell-off is only half done. Okay, but look at it. This is a case where your assumptions drive your conclusions, Andy. If you believe that we will emerge from this without a technical recession, because a recession impairs both earnings and the multiple, a double hit.
Sure.
But if you believe, hey, this is like no problem, we're going to skate through this, it's a buying opportunity.